Nice.
We're going to get started in 1 minute. Come on in, get yourself settled, and grab a coffee, lunch, or whatever it is that you're working.
Oh, Jerry West died.
Oof. Good afternoon, good morning, and good evening for those of you on other parts of the country. My name is Bill Bymel, and thank you for joining this episode of the quarterly Win-Win webinar. We have three of the most brilliant minds in banking and real estate finance with us on today's panel. I'm honored to have each of them setting aside an hour of their precious day to talk about the state of our industry. Thank you for those of you that are joining us live in audience, and for those of you that are watching the replay, we invite you to attend our September 11th webinar. That'll be our next webinar. New guests, and maybe we'll get some of the returners. But let's get right into it. We have a lot to talk about, and I want to start by asking each of my guests, the two Bills and Chris, to take 30 seconds to introduce yourself. Let's start with you, Bill Moreland.
My name is Bill Moreland. I'm a partner at BankReg Data. We take the quarterly call reports from the FDIC and we try to turn it into actionable information, both at a macro level as well as at a bank-by-bank level.
Chris?
Well, I'm Chris Whalen. I'm an investment banker. I'm sitting on the floor at Cohen & Company here in New York, up on Columbus Circle. And I publish the Institutional Risk Analyst, and I also publish a column on National Mortgage News. I work with a lot of Ginnie Mae issuers in the industry, and really delighted to be with you all today. I know what Bill Moreland looks like now. This is outstanding. I write about his stuff all the time. So.
Oh, you turned me on to this, man. I have you to thank for this, for introducing me. Mr. Erbey, it's great to have you with us.
Thank you. I'm retired. I'm from the mortgage industry. I started Lockman Financial and Altus Source Portfolio Solutions and 3 other companies in the space. Since I retired, I basically have started 5 tech companies.
You say you're retired, but you never stop. You work harder than most retirees, most working people that I know. Okay, so let's start with an overall, like on a broad spectrum, talking about the state of the U.S. economy. And for the first question, Bill Moreland, why don't you start us off? Do we face the possibility of recession in the near term? I just like to start it off quick.
Yeah. I thought we were going to avoid gloom and doom right out of the gate. I would definitely say if we look at historical activity when it comes to non-performing loans increasing across a number of different portfolios, it does tend to portend economic troubles. The one thing that I would say this time around is when you're printing trillions of dollars every year above and beyond what you bring in, it may throw historical norms out the window. That doesn't mean it won't create other issues. I tend to think we're probably already in a recession in a number of parts of the economy, but I think the amount of money that's been flowing through the system is keeping other parts of the economy artificially afloat. So the question is, how long can we do that, right? Before
Right.
the thing starts to get ugly.
Chris, what is your thought on the overall economy right now?
Well, I think Bill summarizes it well. We're running hot. In other words, the deficits cause inflation. And you can see that in home prices. Even though the Fed has had rates high, quote unquote, for the past couple of years, it isn't enough to cause home prices to go down. You know, in the 80s and the 70s, when I was first getting into finance, the Fed had no problem stomping on the brakes and forcing asset prices to fall. But there's so much debt today, I think they're afraid to do that. So what we're seeing from the Fed is their pretense of fighting inflation, but not ever do they say, gee, we really need to cut those deficits before we drop rates. You know, that's
Right.
the most damning indictment of Jay Powell is his refusal to engage on the budget deficit. That's his job, you know?
Oh, interesting. That's a good point. You know, we have it has been just over 24 months, what, 26 or 27 months since the first rate hike. And I think speaking to what you're talking about, historical trends, you know, historically you start to see cracks coming about 18 months into, you know, after a cycle turns and you see things moving. We're starting to see more and more news every day about commercial real estate. Now, there's been a lot of, you know, clamoring from the rafters, but we haven't seen a lot of it on the street. Bill Erbey, starting with you, do you think the commercial real estate thing is a real problem? And if so, how bad?
I think it's a very serious problem for the economy. You have a huge amount of $1 trillion plus of debt coming due in the next couple of years. There is no demand. There's declining demand for commercial real estate. So I think it's going to be a real problem in the economy. And when that hits when the rollover maturity of those debt hits a wall here.
Oh,
I mean,
yeah.
it's already happening. Go ahead, Chris.
Well, the thing of it is, you know, commercial real estate's a very specialized market. It's an institutional market. So we don't see it in the headlines every day. But if you read The Real Deal, which I do, it's my favorite
I
publication
love
this
it.
year, every day we're rolling assets to the curb and selling them at 50, 60, 70% discounts. So, you know, Bill is dead right, is that this is going to be huge. And it's not just the stuff that is coming due the next couple of years for refinance. It's moribund assets that aren't utilized and that eventually will be abandoned if they can't
Yeah.
be rehabilitated. You know, think about Third Avenue in New York City from 34th Street up to 59. We really need to repurpose all of those commercial properties into something else.
They were
But how do
just
we pay
talking
for
about
New
that.
York without the commercial community, right?
That's right.
If you look at, I heard the other day that Chrysler Building sold a couple of years ago for $800 and some million. It's now sold for like $100 and some million. So when you do the math, effectively New York real estate has a negative value. If you take the replacement costs and subtract it from what value you sell it for, the land actually has a negative value. So the Indians got a really good deal.
No, the Dutch got a good deal. They sold it to the English.
Okay, all right.
Okay.
The issue of repurposing, though, Chris, is a really critical one. When Auckland back in the other I think pre-2008, the crisis right prior to that, we were very big in repurposing commercial real estate, particularly in Lower Manhattan. And it was a very, very profitable business. The difficulty is those buildings that we repurposed were old buildings with very small floor plates.
Right.
You can't take a 50,000, 75,000, 100,000 square foot floor plate and turn it into apartments. It just doesn't work because you're either going to have apartments in the middle that have no windows at all, or you're going to have a railroad. You're going to have an apartment that's 10 feet wide and 50, 70 feet long.
Right.
So it's just not those buildings. The more natural thing historically was to turn them into to rental properties or to condominiums, and that was very effective. These two buildings, they're completely missized for that kind of an application.
Yeah. I heard something like less than 30% of commercial buildings are actually, you could be converted into a residential. They've done some studies on it. And we're not just talking about what we're seeing here, but Bill Moreland, you see this every day in the call reports of banks. And specifically, maybe you could educate our audience a little bit about what's going on in the state of the TDR process and why we know for a fact that banks are already dealing with these commercial loan issues.
Yeah, if you're comfortable, I'm gonna go ahead and share my screen.
Yeah, go for it.
We'll just walk through some of the data, right? And I look at a lot of banks, probably on the phone 4 or 5 times a day, going over client banks or prospect banks. And so you start to see trends. And anecdotally, you have to be careful that you don't draw conclusions. But what I'm looking at here is the industry tab. And so everything that we can get at an individual bank, we aggregate up into a macro for the entire industry. And so what we're looking at here is the non-owner occupied portfolio. And we can see the delinquencies have basically tripled, right? In just under 2 years. We've gone from $6 billion to over almost $18.7 billion. The non-performing loan rate during this time frame is almost tripled, 56 basis points up to 159. And the one thing is, there's a tendency to want to beat on community banks. And I think it's because publicly it's difficult to discuss the issues at big banks because they make us ask hard questions, and plus they don't advertise. And the small banks are easy targets. But the reality of it is every single metric, and by the way, here's a 10-year chart going back in time, that 159. And once again, this is the industry. You have to be careful the 2021 timeframe because of the forbearance and deferrals, and some banks reported them and some banks took advantage of the opportunity to not report them. There didn't appear to be any there were rules. There didn't appear to be any enforcement of the rules. So the 92 basis points, we don't really know what that number was back in real time. I mean, I know it was a magnitude higher, but what was not reported and what was reported, there was a mixed bag. But coming down, the belief is it's the small community banks that are going to essentially have the highest exposure to commercial real estate. And I think that's a misnomer. They have a different asset mix. If you hold a bunch of trading assets and securities, you're not going to hold a bunch of loans. So of course your CRE concentration ratio is going to be much lower. But if we look at this, it's the biggest banks that are having the highest delinquencies or late stage delinquencies. We're talking 447 basis points for the 4 biggest banks, 3.68%. And this is not to say that the smaller banks don't have issues, because you do definitely see some banks having more problems. And it's an increasing number every quarter that are starting to have problems, but it hasn't hit them en masse. My belief is it will. These will continue to get worse. But if we scroll down here and we look, here's the largest portfolios, $69 billion of Wells Fargo. And we're looking at a 5.2% non-performing loan rate on their non-owner occupied portfolio.
Wow. The
second largest is Bank of America, and they're at 5.78. But when you drill down on it, the numbers are atrocious, and you don't hear anyone really talking about this. I mean, they've gone from 79 basis points to almost 6%. And to your specific question, and I'll throw it back to the group, is that's just part of it. Banks can do what they call loan modifications. And what we see here on the same portfolio for Bank of America is they've gone from under $200 million of loan mods to 1.2 billion. So they're reporting to 6.74% of a delinquency rate, which should be headline material.
Yeah, that's bad enough.
Hearing this, but the reality is you got to add another $1.2 billion that they dropped the payments on. If they hadn't dropped the payments on these guys, chances are those would be delinquent. We're really looking at almost 10% of Bank of America, the second largest non-owner occupied lender in the country. Almost a full 10% is either late stage or has been modified to keep it out of late stage. So this is not a problem that's gonna be in the future. This is here. This is, it's not just Bank of America. It's bank after bank after bank. You see the same story.
And it seems like it makes sense that it would concentrate a little bit more in the larger banks because the larger banks had more money to put out and less scrutiny and less, they just, does that make sense, Chris? The logic behind why it would be at the larger banks, or what are your thoughts on it?
It's a different market. The big time commercial real estate market that the JP Morgans and the Wells operate in is totally different from the commercial real estate a community bank would own, and they have to chase big deals. So typically the large banks make big mistakes because it's hard for them to replace assets. Remember, the average life of JP or Wells is 5-6 years. That means 15-20% of their balance sheets turning over every year, and they have to replace it with something else. So it's a competitive environment for the large banks, and Bill's presented this very nicely, which is they do have problems. They just tend to have diversified balance sheets, so you don't notice it. Half of JP is not bank, it's investments. Half of Bank of America, by the way, is Merrill Lynch and the other capital markets businesses. So it's easy to hide it, but I do think it's a big bank problem. I think the small banks will do better managing the credit. You see this with people like OZK and Axos, and they're much better at managing credit. They have big NPLs, but they have very little charge-offs, and that's where I look. I want to see what their realized losses are. But I think Bill's point about modifications is so important, and I want to hear what Bill Erbey thinks about this, because whether it's consumers or business, we're hiding a problem with modification. That's it.
Yeah, Bill Erbey, I mean, it's different than the modifications that you guys did in the Ocwen days post GFC, because you were coming out of a normal interest rate environment and rates were dropping. You could literally drop the pants on your rate to keep people in their homes. We've got rates going in the opposite direction, which is actually causing the problem. Bill Erbey, talk about what you see, how it compares, and your thoughts on all of this, the TDR process.
No, I mean, you're absolutely correct. When you have a rising rate environment, different from a falling rate environment, it's your choices are a lot different in terms of net present value, in terms of the modifications. So, and it isn't just the big banks. CMBS, the insurance companies. I mean, this is just one small part. I don't know, Bill Moreland, what percentage of banks hold CRE? What percentage of CRE loans do big banks really hold compared to CMBS, insurance companies, et cetera?
Yeah, I couldn't speak to that. And another thing that's actually mitigating these numbers is we've got 61 clients that buy CRE off of bank balance sheets. So when you look at the fact that we didn't we've always had that, but the old cycle was REO, and that's where we kind of got lucky and hit that. So I wish we would have got lucky 2 years earlier, and then we'd had a much bigger business than working out of this place. But essentially, I don't think REO, it's going to be there. But what's happening is there's this drive, this punishment of savers. And alternative is driven all the private equity groups over the last decade into buying stressed notes, and it's because it's higher yielding, right? And so what's happening is, even though the delinquencies are well higher than they were 15 years ago on that same cycle, that includes people pulling it off balance sheet. So I couldn't speak to the size of it, but I can flat out tell you we have a lot of clients and a lot of money that's pulling $500 million, $500 million every year. And that goes into a black hole, right? We don't really know what the delinquencies on that are going to be. We don't know what the stress in the market. And so we've had banks going back to 2019 are like, look, hey, we want to grow our CRE portfolio in Nashville. Everything looks great, so we should go ahead and feel comfortable. And I'm like, well, let's pull up your local banks, not your peers, but the local banks in Nashville. And I can show you 2 out of 9 of them sold CRE notes in the last 6 months. So is CRE getting better because the call reports show it may be getting better? Or is it just moving off balance sheet and you are ignorant of it, right? Wow. So the stress is still there. We just can't see it now.
And what does it say for a local bank to be taking their portfolio local loans and trying to sell them off? And that might speak to something in and of itself. I mean, it's not an uncommon process, but it's interesting timing given the market.
Yeah. Well, some banks have a community of people that will buy production from them. And that's a great thing. But to Bill Erbey's question, the non-banks hold more of this than the banks. The banks hold the senior exposures typically, not always. And then the REITs and the developers hold the equity and the immediate debt underneath the senior debt. So I think a lot of it you won't see. It will be resolved privately. There will be a lot of pain for bondholders and a lot of pain for equity REITs in particular. Look at Starwood, look at KKR. In both cases, they've had to come in, support their private REITs, and essentially say to the customers that they're willing to wipe out their equity to protect them. That's an extraordinary thing. And
Right.
you're going to see more of that, definitely.
Go ahead, Bill. Yep.
Yeah, the big problem you have here is that real estate prospers when you have increasing demand.
Yeah.
In other words, in all the other prior cycles I've ever been involved in, they overbuilt, but demand with underlying fundamental demand was going to grow. I think that has changed in commercial real estate. Not only do people go to the office less, but I think you're going to start seeing models where if you're going to have your employees come in 2 days a week, why wouldn't you share office space with some other entity and not basically have all that overhead with regard to it? So what you see in commercial real estate, unfortunately, is collapsing demand. That is a death knell for any real estate product. On top of that, as you pointed out before, the pricing is totally upside down. People were having cap rates that made absolutely no sense in historical perspective. And then you have declining demand. This is going to be a train wreck.
Yeah, no, it is. Related properties, the guys who did Hudson Yards just sold a building down in Hell's Kitchen, West 44th Street. It was originally valued at about 160 million. They just got rid of it for 53 million. And my friend Jonathan Miller, who you guys know, the appraiser here in the city, he said, look, 65% haircuts are typical now. To Bill's
And
point,
that's for
right?
quality real estate, right?
Yeah.
That's for the good stuff.
5 years ago, that property in Hell's Kitchen, as you can tell, because it traded at $170 million, right, was very sought after, to Bill's point. But now it's just a residential neighborhood. There's nothing going on there on the business side.
Wow. So and okay, so let's talk about it. Is it just New York City and states where maybe there's this flight from the regulation, or is it every major city in America that this is going to apply to?
Every city, I think.
Yeah, I agree.
And Bill Moreland, you agree with that? I think it's a systemic nationwide.
Maybe not in Indiana. Indiana's special. I love
I'm big
Indiana.
on anecdotal observation. And unfortunately, you tend to view the world through your own eyes, which is always a trap, right? But, we traveled to Chicago a few weeks ago on a business night, Thursday, and we were able to get a hotel downtown for like $175. And I'm talking, my wife's more picky than I am. Our kids, meanwhile, were in Nashville and the same night, and the apartment or the hotel was twice as high. So you clearly have a difference in certain, right? I mean, I know it's a one-off, but I think there's going to be some metropolitan areas where, whether it's a variety of tax reasons or policing reasons or demographic changes, this is going to disproportionately hit, like maybe it didn't the last time. I mean, just like residential got hit in Arizona and got hit in Florida because of the excesses. You're probably going to see the flip of that this time around, right?
Well, Nashville's a destination, no, Bill. That's what's different about it. If you go to Dallas, downtown Dallas is empty. Downtown Cincinnati is empty, to Bill's point, right?
Yeah.
And it's a sea change. And when you have this and you have profitability falling in these assets and cap rates going up, that's a deflationary scenario we haven't seen in this country in 100 years. That's how far back it goes.
The other problem you have with commercial real estate is it's very expensive to release a building.
Yeah.
The fit ups are extraordinarily expensive to do that. So you add those three factors together, and then the fourth one is I don't know what you're going to do with these buildings, because the new ones aren't structured in a way that they're easily repurposed unless you're going to turn them into a storage center.
Yeah.
It's funny that you mentioned that Third Avenue thing, Chris, because I was listening to Bloomberg earlier today, and the same exact conversation was going on about Third Avenue, and they were talking about the lipstick building, that it would, even like these top of the line buildings that would sell at 50 cents on the dollar today. So what is that? Like we started, it makes some real estate in the C, B, C, and D class worthless or negative worth.
But what's interesting, going back to Bill Erbey's comment, is this: the change in utilization and behavior started a long time ago. Remember when Third Avenue was all ad agencies and advertising agencies? They moved out of New York because their people couldn't live here anymore. It was too expensive. So what you see today is what COVID did was it forced us to change. Remember, in the mortgage industry, we were increasing headcount by a third. We never saw some of these people, and we were hiring them on the phone. And then we sent them a PC and a scanner and said, get to work.
Right.
And it worked. We had the tech to do it. That to me is, it forced everybody to accelerate that change. And we're standing here, but really it started 20, 30 years ago, I would argue.
Right. And it was just,
sorry.
Go ahead, Bill. Go ahead.
The internet's changed all of that. You used to have to, the networking effect occurred because everybody got on the Hudson line or the New Haven line and went into New York City and networked with people.
That's
and
right.
My networking is this. It's on Zoom or Teams or someone of that nature. I don't, you don't have to go into a major metropolitan area, and many of which now are far less attractive than they used to be.
Yeah.
I want to take a step back, and we'll come back to commercial real estate. No, there's a lot more to discuss here, and banking, but I want to take a step back to residential for a moment, because Chris, you specialize in the Ginnie markets, as you stated. That is your FHA borrowers, stuff like that. Is there anything that you're seeing right now that we should know about, that maybe is, the media is giving us a head fake on, or what's kind of the state of residential? And then if you could speak to what all of this conversation on the commercial and banking cost of capital side might ultimately do to resi.
Well, I think the first thing you have to say about resi is there's two things going on. The asset is fine. It's almost impossible to lose money on a residential mortgage loan because of home prices. Right. Well, seriously, the bank portfolio net losses today in the first quarter of this year are zero. So loss given default on multifamily loans owned by banks is 100%. And loss given default on 1-4s, $2.5 billion, is zero. Wow. So when you look at that, it tells you, wow, credit perspective, no problem. But what about the families? What about the borrowers? These people are getting kicked around. So while it's easy to look at home prices and say, oh, well, the market's great, right? The reality is that bottom third, which is mostly in the FHA market, never really recovered from COVID. They lost jobs, they were on debt moratoria or rent moratoria, whatever. And they're still kind of in a confused state from an economic perspective. And then we have this inflation that follows on. So it's not just a matter of affordability, Bill. It's a matter of how much more pressure can we put on borrowers before we do see credit problems. And I think that's next year, by the way.
Next year.
I think it's when the Fed suppressed credit for years after 2008, which is what they did, now they've stopped. So what does everybody think is going to happen? We're going to revert to the mean, and we're going to go above the mean, Right.
Okay, good. Big, broad question, because I want my people and I want the world to hear it from the pros. What is normal interest rates?
Where we are now.
How old are you?
Yeah. So I did a conversation with Bob Brusca this week in the blog that's free, by the way. And he talked about this, which in 2015, 16, Yellen and all the rest of them were trying to normalize rates. They wanted to get them up in case they had to use them again down the road, right? And then COVID entered, and you had 19, 20, 21 of extraordinary ease, back down to zero. They cut the duration of our resi market from 5 down to 1, which I don't think was even possible, but we did. I had the chart from Bloomberg, by the way. So, here we are today, and I think normal for Fed funds would be for something. The question is, what does the rest of the curve look like in that kind of market if, Janet Yellen's out borrowing $500 billion on average every quarter?
Bill Erbey?
No, I mean, I think this is more average rates than this is really much more of a historical norm right now today. But, I do think that these rates are ultimately going to have a significant impact on housing prices. What I think we've had is two fairly unusual events that have occurred simultaneously offsetting each other, one of which is essentially Airbnb or any of those have distorted the housing market. And also the entrance of people who are renting properties have distorted the housing market. You can't take 4% of your homes out of inventory and then wonder why home prices stay up.
Right.
And so if you have a recession and people can no longer spend money and travel, I think that's going to have a huge impact. Obviously, on the other side, everybody borrowed at 1%, 2% interest rates, very low rates. So the pressure on them is very low. But inflation is starting to hit many of them because insurance costs are through the roof, taxes are through the roof. Those costs are a function of the value of the property. People wonder why in Florida their insurance is doubled. Well, the value of your house is doubled. So don't be shocked that your insurance is going through the roof. Don't be shocked when the local governments are spending so much money while your taxes go through the roof. So
right.
Whereas it's been ameliorated by having ridiculously low interest rates on the mortgage, those other costs in many cases are going to get bigger than the actual mortgage payment if this continues much longer. And if the consumer gets out of, weakens here and doesn't travel as much on Airbnb and things like that, and those homes get thrown back into the housing stock, you throw even half the short-term rentals into the housing stock and you're going to have an oversupply of housing.
Yeah, well, what's so important about what Bill's saying, Bill, is that if you look at new condo developments in Florida, more than half of them, and these are typically high-end buildings, allow short-term rentals. They're designing the project with that baked in. Why? Because owners need income. They can't, sustain it all year without renting it. To Bill's point, if the Airbnb market goes away, what happens to those developments that are predicated on somebody getting a couple months of income every year?
Anecdotally, I will tell you, I've been hearing about people that are buying a lot of spec properties in Florida and sitting on 3 and 4 properties thinking that that this is just going to go forever.
Wasn't there a movie about this? I think it was The Big Short.
Yeah.
We lived that movie. Are you kidding me? And Bill Erbey is the reason he's on an island somewhere because of that.
Exactly.
But one thing too is if you look at vacancy by state, it's shocking in some states.
Oh.
New York, California vacancy rate is above where it was in the recession.
Wow.
People just are saying they just don't, they're not grasping reality at this particular point. But the overall vacancy rate is low, but in certain states it's really just stratospheric.
And if you look at Fred, there's, they do track privately, new construction, private units under construction. And for the last 2 years running, we've had 1.65 million units of multifamily under construction, while there's this shadow inventory that you guys are speaking to. So it wouldn't be unusual, and we've seen it before, to go from an undersupplied market to oversupplied in relatively short order, which in the residential world is what, a year, like you pointed to, right, Chris? A year, well, that's all thought. Let's go back to banks then for a second and talk about their reserves. Bill Moreland, what do you've touched on bank reserves, and I know it's a you don't want to go too deep into your philosophy about it, but why don't you give us a little thought? Maybe you will.
I'm perfectly happy to put it out there.
Okay, let's talk about it. Yeah.
So, you know, I talk to a lot of people, right? I mean, we all do, but and I'm fortunate that a lot of smart people are clients and they drip knowledge into me. But one of the things I've always struggled with is allowance and reserves. And basically, I think a lot of the traditional ways of setting allowance, and that every generation throws up its next name and moniker and an acronym, and CECL's it, right? CECL's going to solve all problems. The reality is outside, and I think what happens is statisticians who don't know banking, sometimes culturally have different backgrounds, are now tasked with looking at big data sets and coming up with allowance. And what ends up happening is you end up, because so much of the banking system is now aggregated into a handful of super tankers, right? Oil tankers. The belief is I can build a model and it works well. Like there's this dial on the oil tanker and you're going to steer Wells Fargo and Bank of America through the shoals of allowance and delinquencies. The reality is for any bank under $40 billion, you're reserved until you're not. And it's not going through the shoals, it's hitting the iceberg and then hitting another iceberg and then you're done. And that is how I'm very much, I say it again and again and again, you're reserved until you're not. You're reserved until you're not. And you can demonstrate it bank after bank after bank. And I just wrote something on Merchants Bank of Indiana because I'm not picking on them. They're publicly traded, they're fair game, but they look great. And then they're not. And now they look horrible, right? And you can't make that up. On the flip side of this, I talk to a lot of small banks and they call up and they're like, Bill, you got to help me. Like, what? You got to help me get the right peer group. And that's always the right answer, right? I got to get the right peer group. Okay, what's the story you're trying to tell? I'm trying to tell the regulators that I have not enough reserves. I'm like, whoa, wait a minute. You have not, and it means they want you to have fewer reserves. Yes. And I would hear this 3 times in the last 3 months. A bank would call me up, and a small community bank, 200, 300, $1 billion in assets, and they're being told by the examiners they don't have enough reserves. I'm like, but it's like $2 million, dude. It's not, there's no way you have enough reserves. And you hear this, and so finally you just start saying, why? Because the IRS is worried we're hiding income by dumping it into provision that dumps it into allowance. I'm like, you got to be shitting me. I mean,
well, it's the age-old problem. We've been arguing about that for 50 years.
And so we're headed into a hurricane, multiple hurricanes of portfolios, and regulators are telling small community banks, you've got too many reserves. Stop, take some out. You need to take a negative provision. It's just mind-blowing.
Yeah, but it's because realized losses fell, and that's why they pushed CECL down. I totally agree with you. It's a silly model, but that's what's going on. When you see realized loss fall, the auditors all get, antsy, and they say, "Oh God, you got too many provisions."
Yeah. If you wanted to take a look, I'll share my screen and
yes, go for
it. But just a cycle, and I'm not cherry picking, right? I mean, I'm not trying to basically beat a narrative. We talked about Bank of America. By the way, their performing TDR issue is not just commercial real estate. They're doing it on every single one of their portfolio. Now, don't look at this.
Oh,
that doesn't count because the FDIC conveniently redefined what TDR is. After 40 years, we just come up with a new definition. So really, that's the new starting point, right? So you ask yourself, why did the FDIC rechange the definition? Because they know there's this wall of modifications coming. And you come in here and you look and you see that portfolio after portfolio. So we know that Bank of America has a bad habit right now. So we wiped away $4 billion. Most of those were mortgages that are Fannie or Ginnie that no longer ever get charged off as of 2012 re-election cycle. But we know that they're playing this extend. But if you do look at their non-performing loans, they're skyrocketing. So the question is are they reserved? I never look at this ratio. I don't care about this ratio because the loan books are all different. So allowance to loans, I'm not a big fan of it. I look at coverage ratio, which are reserves to NPLs. And we adjust for government guarantees. So we're taking out if there's any SBA or Ginnie or any other guarantees that are on there. Loss share when we did have it, then we got rid of it. Now it'll come back. We're not reserved, right? We're not. Bank of America's reserves they're trying desperately to get the number up. But the problem is they've gone from 12.5 billion, and this is the depository, right? I'm looking at the depository level, the call report level data. They've added $600 million, but during that same time, they've added $2.5 billion of liability. And it's not just them. I mean, you can basically cycle through bank after bank after bank. Here's our favorite one, right? Who could have saw this coming? They're not reserved. They're not. And it's just bank after, and I'm picking big banks. They look reserved. They got $3.70 of reserves for every dollar of non-performing loans. Now they got 84 cents. They're not reserved. This doesn't include performing TDR. That's how we hide it. And this doesn't include increasing early stage delinquencies. So not every single bank, and I would argue that the smaller the banks, to the point that was raised a little bit earlier by Chris, is there's a lot of really good community banks that are 3, 4, 5, $10 billion that have done a very good job of managing. They're typically not publicly traded. They're typically multiple generation.
That's right.
But there are a lot of good banks out there, but across the board, we're not reserved enough. If we were to look across the industry, the numbers, and I'll show you, there's the industry, asset quality, going to reserves, the numbers are coming down. This is dollars. So we used to have $2.85 just a year ago, and now we're down to $2.25. And you can argue that it's higher than it was before. Yeah, but we didn't have any delinquencies then.
Right.
Now we got 5 times as many, right? So I don't think it's gloom and doom, but I think there are going to be a number of banks and probably a handful of big banks. It's going to become very clear very quickly. They're going to have to start taking income hits to set aside more reserves. Provision.
A lot of them, I mean, Bank of America is an extreme example. They've got $500 billion worth of securities, and I think the yield on it is 4. So, you just do the math. They're not throwing off enough income to fix the problem. I've always argued that the good banks are the ones that have the income that when they see a problem, they can just attack it and they make it go away. It's not a matter of capital. It's, do you have the income? And BA does not. They're dead in the water.
So how does that work out? What does that look like? Let's spend the next 15 minutes pulling out our crystal ball about the next 5 years. How does it get dealt with?
They're going to have to sell risk, and it's going to come out of income. That's the only way to do it. And by giving that risk to other investors, they're going to basically have very poor returns until they can earn their way out. And remember, that securities book is not prepaying. Those mortgage banks that he owns are not going anywhere. And it's a shame because during the crisis, he could have sold all those 2s and 3s for 104 and bought T-bills. That was the trade. And the banks like JP that are a little more attentive on duration, they missed this hazard. But banks that were not paying attention to the Fed, and in fact didn't listen to the Fed, right? That was the Silicon Valley Bank problem. They are in much better shape. There's a huge dichotomy in the industry between people that followed the Fed and weren't thinking about it, and people who focused on reality, which is if I'm in the midst of a crisis, I buy T-bills. That's the only thing I buy.
And as you pointed out, there are a lot of small and community banks. Bill Moreland pointed out that most of them are not the publicly held ones, but the privately held ones that really know how to run their business. And I've heard, I know, for instance, one of my partners, tells me a story of he sits on the board of a bank and he came in, 3-4 quarters ago, and the CFO had basically told the board that he sold some of these securities. So this would have been, this was before SVB. So maybe it was like 2 years ago. He had come in and taken a loss on some securities short term, and it was right before SVB. And he looks like a hero now. But at the time, they didn't get it, right?
Right. Well, but Joe Garrett and Bill McCauley talk about that all the time. If you have the income, you take the loss, you redeploy the proceeds, and you dig your way out of the hole.
That's right.
That's obviously the trade, right? And the smart banks have been doing that. You can see it because they take the losses. That's a good screen for you, Bill. Bill Moreland, you ought to do a who took the pain in 21 screen.
Yeah, no. Well, and you can see, and then
that's not bad. Yeah.
the Fed kind of took the rug out of a lot of banks in Q4 of 23, right? Higher for longer, and a bunch of them went and sold, and the industry lost like $2 billion on realized securities. And then we talked pivot, December 13th, and then drove the mark-to-market losses down a couple $100 billion, a side benefit. I'm sure it was totally unrelated. But no, there were a lot of banks. But getting back to Silicon Valley Bank and banks that were smart, if you would have been paying attention to Silvergate Bank, they liquidated their entire held to maturity portfolio 3 months before Silicon Valley Bank would belly up. So and I can't tell you how many people I talked to, and this gets back to what's the normal interest rates. It's become very clear to me talking to bankers that don't know how to compete for deposits because they're 36 and they've only ever been a manager or moved up or a branch manager, and now their deposit, their frame of reference is zero. You mean I actually have to pay for deposits? No. That's going to go back to zero. And then you talk to treasurers of private equity groups. And last March, I was stunned. I'm a Yahoo, right? I'm nobody, but I've got people calling me saying, look, I got $150 million. How many banks? 3. When do you need this money? 6 months. Why do you have it sitting in a bank? Why aren't you earning 4.5%, 5% in a T-bill? We looked at it and we weren't comfortable. And I heard that again, 120 million, 150 million, 180 million. I'm like, good Lord, what? And then you go look them up on LinkedIn and you realize they're very well educated, but they're 36. And so they think a bank is safer than treasuries. And they may be right in the long run, but at least now and so you wonder, how does Silicon Valley Bank pay a nickel and turn around buy long-term treasuries or mortgage-backed securities yielding 107? That's why, because there's a whole bunch of people out there that have been raised under 0% interest rates that they don't think any differently, right? They think it's going to go back to zero. So when it goes back to zero, I'm not losing anything. And I'd rather have access to that cash. It's like, well, you can sell a treasury, you can sell a T-bill. But it was remarkable the number of conversations I had last March and April at a lot of name firms. There was that conversation. And so that's why I said a little bit earlier, what's the right interest rate? Depends how old you are.
Depends what your generation. No, and you hit the nail on the head.
A lot of people think this is not right. The government is making things more expensive. No, the Fed's going to make things cheaper. You just have to have some pain, and cheaper means normal,
right?
But they don't think that's normal, right?
I remember in the 1980s when my father came home with an FHA mortgage at 11 1/4, and they were jumping up and down in the room. How proud they were.
And the house was $70,000.
That's right. That's the difference, right? And it's a direct correlation, folks. I mean, it just is what it is. It's a numbers game. Bill Erbey, you have been through two great cycles. You founded Ocwen on the ashes of the S&L. I mean, that's really what you must be, if you're looking at this now from the perspective of having done that, and then obviously Ocwen, became the 800-pound gorilla after GFC. Which one is this more like? What do you see coming in banking? Is it mass consolidation? Is there a too big to fail? What's your perspective on it, Bill?
I don't know about that, but I mean, your first question was, are we going to have a recession? And Bill Moreland has an excellent report. I think based on that report, you can say yes, the banks are going to cut back like crazy. They're going to the regulators are going to come in and basically say, you're under reserved, you need to stop making these loans, and that's going to basically slow the economy down dramatically. So I think that's going to happen. Commercial real estate will be worse than you've ever seen, I believe, with regard to that. So I do think I believe that housing, since the beginning of data, home prices are a function of affordability. So that means home prices are probably at least 40% overvalued today. Now you can levitate it for a while, and then basically around before 2008, you were like 3 standard deviations in home prices above where they were, and you are easily there today. So it's not that there's no way that home prices do not adjust to affordability. Over it may take a while. Maybe it takes a little longer here because so many people have such low interest rate loans. But over time, that adjustment is going to occur, whether it be through insurance or taxes, et cetera. So I think the economy is under some real pressure. Look around globally, we are a global economy. Canada's real estate market is going to be single family residential is going to be a train wreck. 5-year mortgages, okay, they're gonna have the same cliff you have in commercial. They've overbuilt with regard to that. So I don't see a whole lot of positives out there for from the economy, picking up. The consumer's under pressure. You see many of the standards of different types of consumer debt or delinquency rates are rising with regard to that. So it's not. I think it could end very badly here.
Well, and I want to come back to you on that question, but I want, Chris, your thoughts on what Bill Erbey said about residential in the long run.
Well, I defer to Bill. I also have a biography on Stan Middleman coming out in September, and what Stan said is misery on the eights. He's a big believer in long cycles, and he said, they'll drop rates, we'll have a little boom, there won't be much volume, but we'll do the boom, prices will go up more, if you can believe that, maybe double digits initially, and then we correct. And he thinks that's around 27, 28. Maybe we go back down to 2020 levels, which is half of what Bill was just saying. That's only 20%.
Yeah, that makes sense. So a little bit more of a maybe a little correction, then another bubble, then a real correction on the resi side is kind of your.
Well, if you see supply one way or another, who knows how that supply manifests itself?
Right.
I don't think it'll be new construction, but if we do have a lot of people sitting on spec properties and they have to release those over the next couple of years because of a lack of demand, then all of a sudden, South Florida, which people are already talking about, by the way, they're already talking about Florida cooling off. I think same could be said for Dallas. Look at South Lake. Look at that whole area out by the airport. It's incredible. It's like we recreated California and South Texas. I don't know.
I don't know if that's a good thing or a bad thing. I'm not sure.
But you know what I mean. We moved the mortgage industry to Texas from California. They couldn't afford to stay in California.
That's right.
And now, they're overbuilt. Even, existing assets 5 years ago that were fine are now made moribund because there's a new mall down the road that was just built on spec. And you see this over and over again in Florida as well.
Yeah, and the insurance thing is that we haven't even touched on that. I've got.
Well, but you said it, value. It's a matter of valuation. I think it was Bill Erbey who said that.
Yeah,
if
he
the house
did.
doubles in value, then the insurance has to go up. We don't have that problem in New York. New York is still kind of flat on its back when it comes to pricing.
Yeah, I mean, there are more events obviously happening, that in the last couple of years, even the insurance companies. I think that's all very well said. Let me come back to where let me try and we want to finish with a little bit of a positive slant. And maybe, I don't know, Bill Erbey, if you can help me here. If you were me, a young, beautiful executive in the business wanting to be the next Bill Erbey, where would you look for the opportunity in today's market?
You're talking about from a real estate perspective?
Yeah, from an investor's, investor perspective, where would you look for opportunity?
This is not a positive note. I wouldn't invest in real estate today.
Get out of real estate.
You're asking the wrong person when you ask for something positive about the real estate market today. I really don't have any very good ideas at all where one would look. It's
Well, you definitely want to own MSRs. I think that's obvious. But I think years ago I took my nephew to see one of the big real estate lawyers in New York, and he had been doing fix and flips on the island, and he wanted to get into big time development. So the lawyer looked at him and smiled. He said, "Kid, you got a great background, but you need to change the word development into restructuring, because we're doing restructuring now. So if you want to get into this business, you're going to do restructuring." And that's okay. I work for 2 receivers. There's nothing like going through somebody else's problems.
Yes.
You're going to learn a lot.
That's what we do. No, that's exactly what that's what I 100% agree with that. So Bill Moreland, I didn't ask you how you see it all panning out. Going back to this, whether it's a B of A situation, I mean, I think it's pretty much agreement on this panel. I hope that nobody from B of A is with us. But the agreement is that it's somewhat of a dead man walking a corporation, or on the other side of the spectrum, those operators that are the smaller banks that maybe got caught with their hands in the cookie jar. How do you see it all panning out?
I wouldn't go so far to say Bank of America is dead man walking. They got issues. And they're gonna and there will be some dead man walking though, right? We don't fully know who they are. Got a couple of names. I'm not gonna mention them, but there's people you can, when you do screens and you're doing anecdotal observations and you're walking through clients and prospects through bank after bank, you see certain banks that are, they're restructuring their loans, they're performing, and then they drop. And everyone's like, well, this is a good news. I'm like, no, because they went performing to non-accrual, which means you just restructured them 9 months ago, and now they've gone back into delinquency. That's not supposed to happen right away, right? So you can find banks that have these problems. But what I will tell you is, after watching this data for 2 decades, and I've been working with this data for 2 decades intimately, our system's not set up to take pain. And so is it out of the realm? And we were telling people, after Silvergate, our phone started ringing on Silicon Valley, and their client, I'm not going to publicly trash them, although I should have been a little bit more vocal because it was obvious what was going on. But basically, it was obvious that the answer would be a bailout facility. And we were calling it BFF, best friends forever. The Fed's your best friend. They're just going to come up with and then it was BTFP, and people were like, how'd you know? I'm like, I didn't know, but the answer is always more money. So is it outside of the realm of possibility? And I know that this sounds crazy, but what's to keep, since our system politically is not set up to take pain, and it's progressively becoming less worried about the future. I don't want pain in a re-election cycle. We come up with $1 trillion CRE to multifamily conversion migrant housing omnibus spending plan. And you can say it ain't going to work, but that doesn't mean they won't do it. So I tend to agree. I don't know about the cycles, and I don't know about the eights. That's fascinating. I'll go look at it. They will try to avoid pain, but we're pushing on a string, right? I mean, I don't know that you can solve any more of these problems without inflation and it's way higher than we report. I shop, I know it's painful. But I don't see how we don't try to solve this with more money, cheaper money, and then it's just going to take off afterwards. What I used to think and what I used to be told was farmland. But we started to see 6 months ago, people are saying farmland's starting to experience stress. We want to look for bank reg data to find banks that are having farmland issues. I'm like, there are none. And now there are some.
Wow.
So these little pockets that you think may be safe, people are seeing that they're not. And now they're starting to see banks are starting to have problems even in ag,
Wow.
which is kind of a
But,
safe place for a long time.
To Bill Moreland's point, think about the fact that Martin Gruberg is still sitting on the signature bank loans inside the bank insurance fund. Why are they doing that? The same reason they got rid of troubled debt restructurings. They know that there's a problem.
Yeah.
They know that it's a big problem. And they weren't prepared last year. They had to do the systemic risk exception and bail out the depositors of those banks. They may not be able to do that in the future because they don't have the cash. And this notion that the Treasury could just float $1 trillion for, multifamily problems, I think that would really push the limit on investor tolerance with respect to the Treasury.
I mean, government intervention does seem to be the way this decade.
The tradition in America, of course.
and you actually, when we recorded our podcast a few months ago, you and I were talking about this. What was the solution? What could be? And I said, would there be a new RTC? And you suggested something more like an FC. Yeah. What was you want to share your thoughts with that? I love that.
It's a big financing vehicle for things that cannot be financed. Busted real estate in urban areas. The cities and the development community are going to have to figure out what to do with those assets. And it's going to be hard to finance them unless there's some clear path to profitability. Bill Erbey was talking about this before. If the building's not profitable, then we have a problem.
Right. All right, Bill Erbey, last thoughts before I call it a day on all of this. Any words of wisdom for us?
I wouldn't say words of wisdom. I've been out of business for a decade, but you know, the other area that I think you'll see tremendous stress is single family rental, because they finance themselves the same way they do in Canada, and they commercial, very short term, you know, 5-year notes, large amounts of
Well
property
said, yeah.
at cap rates that are simply unsustainable with regard to that. So that may not end well at all.
That's another source of some of that shadow inventory and resi side, where you talk about the Airbnb, but you know, you see the huge uptake of the private equity's involvement in single family is another way that the single family market got starved of inventory the last 5 years. 100%, that makes sense. Bill Moreland, last thoughts? Oh, and you know what? I did get a quick question before Bill, but let me step back. Can you quickly just discuss for the guests? One of our guests said, can you discuss a little bit more about that MSR opportunities? You just quickly said now is the time to buy MSRs. I don't want to step over.
It's not an opportunity for everyone. It's an opportunity for the 3 or 4 big issuers who have not gone public, who have not participated their MSR out to BlackRock or somebody else, and who now are cash rich, and they're paying half a multiple above the market to buy servicing, because they know that given where interest rates are, there's going to be very little turnover in those assets, and they're going to have great yields. Unfortunately, this is just not something you can get into as a small investor, even a small mortgage issuer, because the small guys can't compete with the big guys. You know, who are they? Freedom, Bayview, Cooper. You know, they have firepower and they're exercising it. All of them are heading for over $1 trillion in servicing.
Wow. Really great stuff, gentlemen. I appreciate that you. Oops, I was wrong share. I appreciate you both. Just giving me my whole thing. I appreciate you all being here with us today. It has been a captivating conversation, and we look forward to seeing you on the next webinar. Thank you all for being with me, gentlemen. Thanks.
Thank you, guys.
Thank you.
Have a nice day. Bye.